You walk into the dealership and sit down across from the salesperson. You need a car. Maybe your old one finally gave out, or you have a new job with a longer commute. So you sign the papers. The monthly payment looks manageable. You can swing it, so you drive off the lot feeling good about the decision. These deals are designed to look affordable on the surface, while they quietly pull wealth out of your life for years. This strain occurs because car loans are structured to keep you paying as long as possible, while the vehicle you are paying for loses value every single month. The danger of the car loan is that it feels completely normal. It looks like a responsible, mature decision, while the math tells a different story. I fell into this exact trap in my 20s. I bought a car I thought I could afford and stretched the loan out to make the payment work. 3 years later, I owed more on it than it was worth. It took me years to dig out. For many families, a car payment is one of their biggest expenses right after housing, with monthly bills often running several $100s. Because these payments are so common, most people never stop to question whether they are actually a good financial move. When everyone around you is doing the same thing, a quietly expensive mistake becomes an unquestioned habit. A car is one of the few things people borrow money to buy that loses value the moment they own it. This teal bar represents the car's value. The second you drive it off the lot, that value starts dropping. While the car's value falls, your loan balance stays exactly where it started. You are paying interest on the original loan amount, regardless of what the car is worth today. This gap between the two bars shows how much you are overpaying for the asset. Every month, that gap continues to widen. You are paying more for something that is worth less. This is why many middle-class families feel financially stuck, even when their income looks solid on paper. You are locked into a premium price for a machine that is strictly engineered to lose its value. Every single month, you are handing over cash for a machine that is worth less than it was the day before. This wouldn't be as damaging if we only bought one car, but most people buy several over a lifetime. If each new vehicle comes with a long loan and a big payment, that pattern repeats for decades. Money that could have gone into savings or investments is redirected to a machine sitting in your driveway that is worth less every year. A lifetime of unexamined car payments makes the machine in your driveway a primary source of your wealth's erosion. This is not about never buying a car. Most of us need them. This is about understanding the math so you can stop handing away your future wealth without realizing it. If you have a car payment today, take 2 minutes to check its actual value on a valuation site. Compare that number to what you still owe on your loan paperwork. If you owe more than the car is worth, you are what is called underwater on the loan. Most people never check. They just keep making the payment every month without knowing where they stand. Knowing that single number changes how you think about your next move, shifting you from sinking deeper to moving toward real ownership. Buying a car with a loan sets two very different financial forces into motion the second you leave the lot. The physical vehicle immediately begins losing its value, while you begin the long process of paying down the money you borrowed. They move in opposite directions. Imagine a $35,000 car loan. Both the vehicle's value and loan balance start here at the top. Driving home, the car's market value instantly drops to $30,000. Your loan balance decreases slowly. It hasn't moved. You still owe $35,000. Before you have even parked in your driveway, you are already $5,000 in the hole. Car loans are heavily front-loaded with interest. In those early months, a large portion of your monthly payment goes directly to the lender as a fee, rather than paying down what you actually owe on the car. Look at this breakdown of a single early payment. The large block is the interest. That tiny sliver left over is all that actually goes towards your principal, which is why your loan balance barely budges. As your balance inches down fraction by fraction, the car itself continues its steep decline on the open market. This expanding empty space between what you owe and what the car is worth is called negative equity. It simply means you are in debt for more than the physical asset can be sold for. It feels like you are making financial progress because you are making your payments on time every single month. But because the car is depreciating faster than the loan is shrinking, your actual net worth is actively dropping. Fast forward to your final payment. You didn't pay the sticker price you agreed 2 years ago. You paid that price plus thousands of dollars in accumulated interest, and the machine sitting in your garage is now worth a fraction of what it cost on day one. To see why this matters, compare the car to a house. These two graphs show the difference. Both require paying interest on a loan. But on the left, historically, the home holds its value or trends upward over time as the mortgage drops. On the right, the car's value collapses beneath the loan. With the house, the expanding space between your shrinking debt and your stable asset is positive equity. You actually own that value. One debt helps you build wealth over time. The other forces you to pay interest on an item that becomes less valuable every day. Many drivers replace their vehicles every 5 or 6 years, taking out a brand new loan each time. If you stretch that behavior across a few decades, the total amount of cash flowing out of your bank account into monthly payments, interest charges, and depreciation is massive. All of that capital is entirely consumed by the vehicles. It never gets a chance to sit, earn interest, and compound for you. Repeating this cycle drains the exact funds that could have secured a house down payment or an early retirement. Say your car payment is $500 a month. Imagine redirecting that exact same amount into a standard investment account. This chart tracks those $500 contributions over decades. Because of compound growth, where interest earns interest, that steady deposit curves upward into a small fortune. Look at that final peak. That lost potential is the true hidden cost of financing cars. This math does not mean you should never use a loan to buy a vehicle. Sometimes financing is your only practical option. But once you see how these loans can drain your net worth, you need to know how to navigate the dealership without falling into a trap. Mastering the math behind depreciation and compound interest is how you stop your money from working against you and start keeping it for yourself. The moment you drive off the lot, the underlying mathematics of a standard car loan begin working against you. You are linking a rapidly depreciating asset to an interest-bearing debt. Making a few specific financing errors turns an already expensive transportation purchase into a severe, long-term setback for your personal finances. At the dealership, there are 4 extremely common traps that create a compounding cycle of financial damage. Recognizing how these traps actually function is the only reliable way to keep a routine car purchase from eating up the cash you need to build long-term wealth. Mistake number 1 is calculating affordability based entirely on the monthly payment amount. Dealerships know exactly how to exploit this metric. Once you provide a monthly number you feel comfortable with, they can manipulate the back-end terms, stretching the duration of the loan out for years so almost any car fits your requested budget. Securing a lower monthly payment guarantees a significantly higher total cost. You pay the maximum total interest, the vehicle's value drops aggressively before paying it off, and you carry a loan balance exceeding the car's value for much longer. Stop thinking about what you can afford per month. Start making your decisions based strictly on what the car will actually cost you by the time you make the final payment. Mistake number 2 is rolling negative equity forward. Say you owe $20,000, but the car's market value is $15,000, leaving a $5,000 gap. When that gap sinks below actual value, you are underwater. The dealer then rolls that leftover debt into your new loan. This mechanically guarantees that you are financing the cost of the new vehicle plus the leftover debt of the old one, making your new loan noticeably larger than the car's actual worth from day one. This creates an escalating debt loop. Buyers who repeat this process through multiple trade-ins over a decade often find themselves owing vastly more than the asset in their driveway is worth. If your loan is currently underwater, the most mathematically sound tactic is to keep driving your current vehicle until you pay the principal down enough to reach the break-even point. It lacks the emotional thrill of a new purchase, but it is the only mathematical method to stop the debt hole from expanding further. Mistake number 3 is stretching the loan term out to 72 or 84 months just to capture the appeal of a smaller monthly burden. The sharp downward curve of a vehicle's value in its early years outpaces the extremely slow, flat payoff slope of an extended loan. A massive gap opens up where you pay additional interest while holding an underwater asset. You should aim to secure the shortest loan term you can realistically handle to minimize total interest and breach that waterline much faster. Mistake number 4 is the psychological urge to reward yourself by shopping for a new vehicle the exact moment your current loan is paid off. The payment-free months that follow a completed loan are incredibly valuable for your personal finances. Resist the urge to jump right back into the dealership for a fresh start and a newer model. This is the critical window where the capital you previously lost to auto interest can finally be redirected into building a real financial cushion. It is easy to make these 4 mistakes because they feel perfectly logical in the heat of a negotiation. The immediate emotional appeal of a lower payment and a brand new interior masks the strict mathematical reality. You are pushing yourself deeper into a permanent, rolling loan cycle. Eliminating these specific errors from your buying process is the mandatory first step to distancing yourself from continuous automotive debt. With those pitfalls identified, we can move into the step-by-step master plan required to break out of the cycle, make your next vehicle purchase mathematically advantageous, and start building lasting wealth. Standard car financing drains long-term wealth, making a deliberate strategy the only way to protect your financial life. Without a specific plan, your vehicle purchase often functions as a steady leak, pulling thousands of dollars away from your net worth. Step 1 requires you to log into your portal and locate your exact payoff picture. You can usually find this on your latest monthly statement or the lender's online dashboard. Look at this dashboard. You must extract 3 specific data points: your remaining balance, your current interest rate, and the exact number of payments you have left. Quantifying these numbers is the mandatory first step. It reveals the exact cost of remaining on your current path and establishes the mathematical baseline for every move that follows. Step 2 is to make 1 extra loan payment this quarter. This chart compares a standard payment to a targeted principal payment. Ensure extra funds bypass the next month's payment stack and apply directly to the principal balance block. Shrinking the principal directly shortens the loan and reduces the total lifetime interest paid. Even applying this strategy once a quarter begins reversing the momentum of compounding debt. Step 3 is to open a dedicated, separate savings account exclusively for your future vehicle replacement. Start making small, consistent monthly contributions to this account. Even $50 or $100 a month adds up over several years. Accumulating this cash allows for a massive down payment or an outright cash purchase. The larger the cash component, the less interest you will pay in the future. At this stage, you are paying down your old loan faster while simultaneously hoarding cash for the next one. Having a cash reserve puts you in the position of a high-level negotiator rather than a dependent borrower. Step 4 is a strict rule. Secure loan pre-approval from a separate bank or credit union before you ever visit a dealership. Relying on a dealer for financing exposes you to marked-up interest rates, extended loan terms, and unwanted bundled extras that inflate the price. Arriving with a pre-approved loan gives you locked-in rates and terms. This provides an objective benchmark you can use to compare any offer the dealer makes. Third-party pre-approval strips the dealership of their ability to manipulate the financial structure of the transaction. Step 5. Target vehicles that are 2 to 3 years old instead of brand new. This graph illustrates the concept of early year depreciation. Buying slightly used ensures the previous owner absorbs this steep cliff drop in value, while you benefit from the more stable curve that follows. Step 6. Define a total vehicle cost cap before you start shopping. Look at this pie chart of your monthly take-home pay. A sustainable budget keeps all car costs within a 15 to 20% slice. This cap must include the monthly payment, insurance, gas, and maintenance combined. Locking in this mathematical budget beforehand neutralizes the risk of an emotional, impulse-driven purchase. Step 7 is the final move. When the car is paid off, immediately redirect that exact monthly payment amount into an investment or high-yield savings account. Your household budget has already functioned for years without that capital in the checking account, making this transition seamless. Redirecting a fixed cost into an appreciating asset creates a compound effect over time. This diagram shows how the same monthly outflow now feeds an upward curving investment line. Car loans are not inherently evil, but they must be managed to prevent them from draining away your life savings. Executing this sequence turns the finish line of a car loan into the starting line of lasting wealth creation. If this video exposed the real mathematical cost of a car payment, leave a like. Send this to anyone preparing to walk into a dealership. Tell me in the comments, loan or cash? Subscribe for new videos every Tuesday, Thursday, and Sunday.